Now let me ask you, have you ever averaged down on a loser? Added more just because it dropped? That's one of the biggest psychological traps in trading. I don't add to losing trades, ever. Why would I reinforce a belief that's already proven wrong if the market's showing me I'm out of alignment? My only job is to recognize that truth and step aside. But traders do it every day. They think they're being clever, improving their average price. What they're really doing is reinforcing denial, digging deeper into a mental illusion. And do you know why they average down? Because they can't emotionally accept being wrong. Ego. That's another major reason traders fail. The ego refuses to take a small objective loss. It whispers, "Hold on, the market will come back. You can't be wrong." But the market isn't personal. It doesn't care about your opinions or pride. It reflects pure information, not your self-worth. The moment you identify with a trade, you lose objectivity. Pride has no place in trading. The market humbles everyone eventually. The sooner you surrender the need to be right, the freer you'll become. Another thing, most traders don't think in probabilities. They crave certainty. They want to know what will happen next. But markets don't offer certainty. They offer potential outcomes. That's all. And your job is to operate within those probabilities, not to predict them. A trader must think like a casino owner, not a fortune teller. But most people try to guess the future instead of responding to what is. And when the market contradicts them, they react emotionally. Anger, frustration, revenge trading. Do you see how the trap forms? Let's talk about capital. Most people come to the markets undercapitalized. They're trading with money tied to survival. Rent money, grocery money, borrowed money. That emotional attachment guarantees failure. The market demands a state of neutrality, and you can't stay neutral if the outcome affects your basic needs. Trading from desperation puts you in a fear-based state where clarity disappears. Tell me, if losing one trade means you can't pay your bills, how could you ever make objective decisions when price moves against you? You can't. The market will sense that fear and consume you. But understand this, many with plenty of capital still fail. Why? Because they think money solves emotional instability. It doesn't. The key isn't capital, it's control. Control of self, of your beliefs, expectations, greed, and fear. Capital magnifies who you already are. Without self-discipline, I've seen wealthy traders implode faster than beginners because they mistake financial power for mental mastery. It isn't. Trading exposes your psychology, not your balance sheet. Now let's go deeper. Why do you trade? Is it for excitement? For the thrill, the rush, the sense of aliveness? If that's your motivation, you're already in trouble. Trading for stimulation is gambling disguised as work. The market isn't a casino, though most treat it like one. It's a mirror, reflecting discipline, patience, and self-trust. Approach it as a business, a process driven by probabilities, consistency, and structure. Without a defined edge and a disciplined mindset, you'll end up like every other thrill seeker who thought they could beat randomness. Another big reason traders fail: they chase the market. They can't let opportunities unfold naturally. They see price moving fast and jump in out of fear of missing out, or they panic sell when it drops, terrified of being left behind. That's emotional trading, impulsive, reactive, unsustainable. You can't chase price and expect consistency. It's like trying to grab a moving flame. You'll get burned every time. That I can't miss this one feeling. That's your subconscious fear of lack talking, not your strategy. The best trades are never forced. They're recognized. The highest probability setups always feel boring. The market always circles back to offer a clear entry if the move is real. But most traders can't wait. They want constant engagement. They need action to feel in control. And that need for control ironically, is what makes them lose it. Here's another mistake. Traders try to pick tops and bottoms. They want to look smart, to catch the exact turning point. But that's just ego-seeking validation. I don't pick bottoms or tops. I wait for confirmation, evidence that the market structure supports my thesis. That means I miss the very start and the very end, but I capture the high-probability middle, the zone of least resistance. That's where consistency lives. Would you rather be admired for calling the bottom once or wealthy from managing risk over hundreds of trades? Most people choose the first, and that's why they stay broke. Another fatal flaw. Traders don't adapt. They cling to what used to work, ignoring that the market is a dynamic, evolving organism. The environment changes, volatility shifts, participants rotate, but the average trader insists reality must align with their expectations. The professional adapts, the amateur resists. The market doesn't punish or reward, it simply responds. It's you who creates the outcome through your perception. Now, do you see why most traders fail? It's not because the game is rigged. It's not because institutions hide some secret formula. It's because most people never master themselves. They don't have the patience, the emotional stability, or the self-awareness to operate in uncertainty. They sabotage themselves. They're not competing against the market. They're competing against their own psychology. Think of it this way. The market is like an ocean. You can't control the waves. You can only learn how to surf them. Most traders dive in without understanding the current, and then wonder why they drown. And here's a truth that stings. Most traders fail because they can't stay still. They think money is made by doing something, buying, selling, reacting. But real profits come from allowing, from being right, and staying aligned with that truth. That's the hardest discipline of all. Anyone can enter a trade. Few can stay in one without the need to control the outcome. Patience feels like pain to the untrained mind. Watching profits fluctuate feels unbearable when your self-worth is tied to every tick. So they overmanage, they move stops, they second-guess. That's emotional volatility, not market volatility. Do you watch every tick and feel your heart race? That's not trading. That's self-sabotage. Hope and fear. Those two emotions have destroyed more traders than any crash or manipulation ever could. You might think it's the market makers or news events that take you out, but it's not. It's internal. Hope and fear are the invisible forces that distort perception and decision-making. Let's break it down. When the market moves against you, what's the first emotion that rises? Hope. You hope it turns around. You hope your belief gets validated. Hope delays the acceptance of truth, and that delay increases pain. You don't exit because hope whispers, "Wait, it'll come back." And the longer you wait, the more attached you become. That's emotional paralysis disguised as patience. Then there's fear. When the market moves in your favor, what happens? You stop trusting it. You think, well, what if it reverses? What if I lose this gain? Fear makes you exit too soon. You cut winners short. You trade from avoidance instead of trust. Instead of allowing the probabilities to play out, you interrupt them. That's why most traders never reach their potential. They're not losing to the market. They're losing to their own untrained mind. The solution isn't more information. It's transformation. Master yourself, and the market will reflect that mastery back to you. Tell me, have you ever closed a winning position only to watch it keep running higher without you? That's fear at work. And here's the irony. Most traders do the exact opposite of what consistency requires. They hold on to losers out of hope and cut winners out of fear. It's completely inverted logic. Yet it's the most common psychological pattern in the market. That's why almost everyone fails. They don't fail because they can't analyze a chart or pick a stock. They fail because they can't manage themselves when they're right or wrong. I've watched countless traders repeat this cycle, generation after generation. They enter a position, price ticks against them, and instead of acknowledging invalidation, they add more. It has to come back, they say. That's hope. The refusal to accept uncertainty. Then, on the rare occasion the trade moves in their favor, they rush to lock in a tiny profit. They can't tolerate the tension of an open gain. That's fear, the inability to trust the market's feedback. Over time, every trader trapped by that dynamic loses, and rarely do they take responsibility. They blame the markets, the brokers, the system. But in truth, they weren't beaten by the market. They were beaten by their own mental framework. Hope blinds. When you're hoping, you stop seeing what is and start projecting what you want. You stop asking, what is the market communicating? And start asking, what do I need it to say so I feel safe? But the market doesn't care about your comfort. It's neutral, completely indifferent to your needs, fears, or wishes. The moment you stop reading objective information and start filtering it through desire, you lose alignment with reality. Fear, on the other hand, doesn't blind. It deafens. When you're afraid, you stop trusting your process. You hear the market giving you feedback, but you can't listen. You assume every valid move is a trap waiting to reverse. So you close early, sabotage potential, and rob yourself of the profits that would have offset your losses. Let me ask you, what feels harder for you? Cutting a losing trade or holding a winning one? If you answer honestly, you'll see exactly where hope and fear hold power over you. Most traders say cutting a loser hurts more, and that's because doing so requires ego surrender. Admitting you were wrong threatens your self-image. But in truth, being wrong is part of the probabilistic game. Losses are simply the cost of doing business. The sooner you accept a loss, the less emotional energy it consumes. Yet hope steps in and says, don't close it yet. Maybe it'll reverse. That hesitation transforms a small, manageable loss into a psychological wound. Now think about the other side. Holding a winner sounds easy, but it's emotionally harder. When profits start building, fear activates. You start visualizing the loss of what you've just earned. So you exit early, believing you're protecting yourself. But that fear limits growth. You never let the law of large numbers play out. You interrupt your own edge before it can manifest. I'll share an example. Years ago, during a major trend in wheat, everything aligned. The momentum, the structure, the conviction. I entered, and price began to move in my favor. Profits swelled, and fear whispered, take it before it vanishes. But I'd learned to recognize that voice. I stayed focused on what the market was saying, not what my emotions were fearing. That single trade paid more than 100 small scalps combined. And it happened only because I trusted the process more than my emotions. Hope and fear aren't confined to individual trades. They infect your entire perception. A hopeful trader searches for confirmation, any headline, opinion, or rumor that validates his bias. A fearful trader seeks protection, interpreting every fluctuation as danger. Both are reacting to inner emotion, not outer information. Both are blind. The market doesn't speak to either. It speaks only to those who listen neutrally. Have you noticed how, when you're losing, the news suddenly seems filled with reasons to justify your position? And when you're winning, every headline feels threatening? That's not the world changing. It's your perception filtering reality through emotion. That's how powerful hope and fear are. They distort the lens through which you see everything. Most traders believe they can overcome emotion with willpower. They can't. These instincts are hardwired. You can't erase them, but you can neutralize them by creating structure, rules, predefined boundaries that protect you from your own impulses. That's why stops exist. Stops aren't punishment. They're protection from psychological distortion. A stop tells you you're wrong factually, no matter how much you hope otherwise. A stop keeps you in factually when you're right, no matter how much you fear the retrace. But even with rules, traders sabotage themselves. They move stops. They cancel orders. They override logic. Why? Because emotion speaks louder than discipline. The market, at its core, is a test of character, not intellect. It doesn't care how much analysis you know or how clever your theories are. The smartest minds collapse under emotional inconsistency, while the most ordinary individuals thrive through disciplined neutrality. Do you see the paradox? It's not the ticker that defeats you. It's your inability to manage internal reactions. I've seen it endlessly. Traders blow accounts because they can't take losses. One more day, one more bounce, one more chance, they say. Those are the words of hope. And I've seen others walk away from massive opportunities because they couldn't handle the discomfort of winning. Better safe than sorry, they tell themselves. But the irony is they end up more sorry in the end. Hope and fear are opposite expressions of the same imbalance, lack of discipline. A disciplined trader doesn't need hope because he trusts his system. He doesn't fall prey to fear because he's accepted the randomness of outcomes. He acts from clarity, not emotion. He doesn't need the market to validate him. He simply aligns with its flow. But tell me honestly, how often do you actually follow your plan? How many times have you sworn never to average down, only to do it again, telling yourself this time is different? How many times have you promised to let winners run, only to snatch them away the moment fear whispered? That's the human condition, and that's why 99% fail. Hope and fear don't just destroy trades. They destroy consistency, accounts, and ultimately, lives. I've seen traders so consumed by hope they pawned valuables just to fund margin calls. I've seen others so paralyzed by fear they quit the markets entirely after one bad loss, even when they had the skill to recover. Hope and fear are stronger than knowledge, stronger than capital, stronger than intellect. If you don't build a framework to contain them, they'll undo you from within. And that's why treating trading like a hobby is suicide. Trading isn't entertainment. It's performance under uncertainty. It's a business built on structure, repetition, and measurement. The market isn't here to amuse you. It's a mirror that rewards discipline and punishes impulse. If you don't manage trading like a business, with planning, journaling, records, and review, you've already aligned yourself with failure. Think of a store owner. He doesn't open the shop and hope people wander in. He manages inventory, tracks results, adjusts pricing, and protects capital. He doesn't gamble everything on a hunch because he feels lucky. If he did, he'd be bankrupt in a week. Yet most traders do exactly that. They click buy or sell without a predefined plan, without risk metrics, without data. Then they wonder why they're inconsistent. Ask yourself, do you take each trade as part of a long-term strategy or as an emotional impulse? Do you document your process, analyze your results, and refine your behavior? Or do you act on feeling and hope the market rewards you? That one question separates professionals from amateurs. Professionals think in probabilities. They run a business of risk management. Amateurs chase emotion, and emotion always loses in the end. The tragedy? Most don't even know they're gambling. They'll insist they're serious, that they've studied indicators or read research. But ask them to show a written business plan, a documented system they can follow and trust, and you'll find silence. Ask most traders what their risk budget is for the month, how much capital they're prepared to lose as a cost of doing business, or how they allocate risk across multiple opportunities. 9 times out of 10, you'll get a blank stare. That's because they never viewed trading as a structured process. They viewed it as a way to win, to score, and the market always punishes that mindset. Here's something I learned early. When I began trading, I documented everything. Every trade, every reason, every outcome. Not because it was enjoyable, but because I understood that awareness comes through structure. Without records, there is no feedback loop, and without feedback, there is no growth. Most traders trade on emotion, tips, hunches, gut feelings. They're not operating a business. They're acting out impulses, and the market devours impulsive behavior. A business has costs, and in trading, those costs are your losses. If you run a store, you expect that some products won't sell, some deliveries will fail, some expenses will rise unexpectedly. Those are normal, predictable costs. You plan for them in trading. Losses serve the same role. They're expenses of participation. But when a trader fails to see trading as a business, he personalizes every loss. He interprets it as failure, rejection, or punishment. And that emotional interpretation fuels destructive behavior, revenge trades, doubling down, trying to win back dignity instead of managing risk. That's when accounts implode. The professional trader is like the calm business owner. He doesn't take a defective shipment personally. He records it, adjusts his process, and keeps moving forward. That's what a mature trader does. Now ask yourself, do you maintain a trading balance sheet? Do you log your returns, drawdowns, win rate, average risk per trade, and expectancy? If you don't, then you're not managing a business. You're dabbling in probability without data. And dabblers always lose to professionals who track and measure everything. You'd never expect a restaurant to succeed without knowing its costs and profits. So why would trading be any different? Yet most traders act as if keeping records is optional. It isn't. It's survival. Another truth, trading for excitement is financial suicide. Many traders confuse stimulation with success. They crave action, volatility, and constant engagement. They want to feel alive. But that emotional craving leads directly to ruin. A sustainable trading business is rarely thrilling. It's structured, patient, and boring. The best trades are calm. They emerge from preparation, not adrenaline. If you trade for the rush, you're feeding the exact emotional patterns that destroy consistency. I've seen traders walk into the office like they were entering a casino, smiling, wired, ready for action. They weren't focused on process. They were seeking dopamine. They didn't want to build wealth methodically. They wanted to feel like winners, and every single one of them eventually blew up because the market doesn't reward excitement. It punishes impulsivity. The only excitement in trading should be at the end of the year, when you review your performance and realize how consistency compounded your capital. The day-to-day experience should feel measured, businesslike, and calm. Capital management is another non-negotiable part of treating trading like a business. No business owner risks every dollar on a single product line. He allocates, he budgets, he ensures reserves exist for lean months. A trader must do the same. Yet most overcommit to one trade, one idea, or one emotional conviction. That isn't business. That's recklessness. And recklessness, by definition, guarantees eventual failure. The true professionals treat risk as inventory. They budget it the way a grocer budgets supply. They know precisely how much they can afford to lose this week, this month, this quarter, and they honor those limits. If they hit their threshold, they stop trading. They step back and review. They respect the process more than their impulses. That's why they survive decade after decade, while emotional traders vanish within years. Documentation is another cornerstone amateurs ignore. Every legitimate business keeps books, receipts, and logs. Trading should be no different. You should be able to pull up any trade and instantly recall why you took it, what your intention was, what you risked, and what you learned. Without documentation, there's no reflection, and without reflection, there's no evolution. Most traders are trapped in repetition because they never examine their behavior. Those who succeed treat their journals like accountants, treat ledgers. They dissect every move. Those who fail treat journaling as a chore, and so they stay stuck in cycles of unconscious error. Imagine running a factory. Would you shut it down after one defective product? Of course not. You'd inspect, adjust, and refine. But traders do the opposite. They blow up accounts, walk away in anger, and return later without changing the underlying process. They never improve because they never analyze. They want results without reflection. Another principle of business. Growth is incremental. A store doesn't open 50 locations overnight. It tests, scales, reinvests, adapts. A trader must follow the same principle. Start small, validate your edge, then expand cautiously. Most traders skip this step. They crave instant wealth. They overleverage, oversize, and overtrade. That's not scaling. That's emotional compulsion disguised as ambition. And ambition without patience becomes gambling fever. If you speak with any professional who survived decades in this field, you'll hear the same message. Trading isn't about excitement, prediction, or quick riches. It's about process. It's about developing habits that align with probability and discipline. Treat each position like inventory. Maintain meticulous records. Budget your risk. Respect capital. Let boredom become your advantage. The amateurs mock this. They say it sounds dull, but dull is profitable. Exciting is expensive. Consistency lives in routine, not adrenaline. And the reason most traders resist this mindset is simple. They don't want to run a business. They want to play. They want to gamble without accountability. They crave the emotional high without accepting the emotional labor. They want profits without process. They want freedom without structure. But the market doesn't reward players. It rewards professionals. It rewards those who treat every tick, every trade, every risk decision as part of a larger enterprise. Those who show up not to feel something, but to execute something. So when you look at that 99% who fail, you'll see the pattern clearly. They didn't fail because of manipulation or because someone else knew more. They failed because they refused to accept that trading is business. They treated it as entertainment, as escapism, as luck. And the market has zero mercy for anyone who forgets that. Most traders fail for another reason. They refuse to evolve. They come into the market with a belief, a method, or a single rigid system, and they cling to it even as conditions change. They demand that the market conform to their expectations, and when it doesn't, they fight reality until the market breaks them. The truth is, the market is dynamic, alive, ever-changing. It breathes, it oscillates. What worked last year might fail this year. What worked this morning might break by the afternoon. Adaptability isn't optional, it's survival. Think about how often traders brag about their system. This setup never fails. This method always works. But no system works forever. No setup lasts indefinitely. Market structure evolves. The participants, volatility, and liquidity all shift constantly. If you don't evolve with it, your edge erodes silently until it's gone. The trading graveyard is full of people who once believed they had it all figured out. They found a pattern, exploited it, and then refused to adjust once it stopped working. They clung to old rules in a new environment. They couldn't let go. They couldn't adapt. I've seen it firsthand. Brilliant traders, disciplined ones destroyed by rigidity. They mistook short-term success for timeless wisdom. They didn't understand that in a probabilistic world, flexibility is the highest form of discipline.